Bankruptcy analysis employs various tools and methods to assess a company's financial health and predict the likelihood of financial distress or insolvency. These methods combine quantitative and qualitative approaches to provide a comprehensive understanding of the risks and underlying factors leading to bankruptcy. Ratio analysis. Liquidity analysis is the process of evaluating a company's ability to meet its short-term obligations by assessing how easily it can convert assets into cash. The goal of liquidity analysis is to ensure that a company has enough resources to pay off its short-term debts and liabilities as they come due. Strong liquidity means the company can comfortably handle day-to-day operations, while weak liquidity may indicate potential financial trouble or cash flow issues. Liquidity ratios are used to evaluate a company's ability to pay its short-term obligations. The current ratio is one of the most widely used measures of liquidity. It compares a company's current assets to its current liabilities, indicating whether the company has enough resources to cover its short-term obligations. The current ratio is one of the most widely used liquidity ratios. It compares a company's current assets, such as cash, accounts receivable, and inventory, to its current liabilities. The ratio measures whether the company has enough assets on hand to cover its short-term debts. A higher current ratio indicates better liquidity, suggesting that the company can easily meet its short-term obligations. However, a very high current ratio may also indicate inefficiency, as it could suggest that the company is holding excessive assets that could be better utilized for growth or investment. A current ratio above 1 indicates that a company has more current assets than liabilities, which is generally a good sign of liquidity. However, a very high current ratio could suggest inefficiency in asset utilization, while a ratio below 1 indicates potential liquidity problems. The quick ratio is a more stringent measure of liquidity than the current ratio, as it excludes inventory from current assets. It focuses on the company's most liquid assets, those that can be quickly converted into cash, such as cash and receivables. The quick ratio is a more stringent measure of liquidity than the current ratio. It excludes inventory from current assets and focuses on the company's most liquid assets, such as cash and receivables. The quick ratio is particularly useful for companies that have significant inventory holdings, as it provides a more accurate reflection of the company's ability to meet its short-term liabilities without relying on selling inventory. A high quick ratio indicates that the company can cover its short-term debts even if it cannot quickly sell its inventory, providing a clearer view of immediate liquidity. Since inventory might take time to sell, the quick ratio provides a clearer picture of the company's ability to meet short-term obligations without relying on inventory sales. The cash ratio is the most conservative liquidity ratio. It measures the company's ability to cover its current liabilities using only cash and cash equivalents, such as highly liquid short-term investments. This ratio provides insight into the company's immediate liquidity position. The cash ratio is the most conservative liquidity ratio. It measures a company's ability to pay off short-term liabilities using only cash and cash equivalents, such as bank deposits and short-term investments. This ratio focuses solely on the company's most liquid assets, offering insight into its ability to meet immediate financial obligations without relying on receivables or inventory. While the cash ratio provides a snapshot of a company's short-term liquidity, it is rarely expected to be very high, as most companies do not maintain enough cash on hand to cover all liabilities. Instead, companies typically balance cash reserves with investments in growth opportunities. While a high cash ratio indicates that a company is in a strong position to pay off its debts immediately, maintaining too much cash may suggest an underutilization of resources that could otherwise be invested in growth opportunities.